afternoon, and welcome to Workforce Wednesday webinars, a professional development series that helps diverse job seekers develop new skill sets that will enhance their careers and influence their personal and professional lives. And now our host, James McFarland.
Good afternoon. My name is James McFarland. I'd like to welcome you to the Urban League of Lexington's Workforce Wednesday. Workforce Wednesday is brought to you by our sponsors, Truist Bank and Toyota 2 Show. Before we get to today's guest, I'd like to ask all of you all who are viewing this program to go out and visit the Urban League of Lexington's social media pages to see what we have going on here at the League. Today's guests are brought to us from Truist Bank. We have Marlo Long, who's the Senior Vice President of Community Development, and we also have Keisha Charles. She's a new business analyst, and they're going to talk to us today about borrowing for small business. Hey, ladies, how are you doing?
Doing great. Thanks so much.
Hey, Marlo, I'll let you start this presentation off, but telling us about what you plan on presenting to the group today.
Wonderful. Let me get the presentation pulled up and we will get started. Today's topic is borrowing for small business. And we hope that by the end of today, you'll have a better understanding of ways to ask for a bank loan, identifying the type of debt that you may need, and understanding how banks look at loan applications and assistance in helping you put together a borrower's profile to make going into the bank to have a discussion with your lender organized and easy to do. Keisha Charles will be our Truist representative that's monitoring the chat room. If you have any questions, feel free to put them in the chat room and she'll be able to answer them or to flag me to see if we can't get any of your answers and concerns addressed by the end of the session today. At Truist, we are a purpose-driven company. Our purpose is to inspire and build better lives in communities. And we believe that small businesses are the backbone of all of our communities and basically the economy. And we are committed to sharing as much information as we can with our small business owners to help put them in the best financial shape that their businesses can be in so that they can thrive and succeed and grow their businesses to the scale that they choose. So thank you so much for joining us today. And if you'd like to scan the QR code, that will take you to our participant workbook that you can follow along as we go through the presentation. So our agenda today. Really, our agenda is designed to help you understand your financing options and the borrowing process to put you in the best position to get the funding that your business needs. The guidebook will help you learn why businesses need funds, where to find funding, how to select the right type of financing, what lenders look for, the borrowing process, how to create your business borrowing profile, and what are the next steps after a financing decision. So for those that are joining us virtually, let's start off by learning a little bit about each other's businesses. Feel free to drop in the chat room the name of your company, what your company does, how long you've been in business, and if you have any specific questions or goals for today around borrowing for small businesses. That'll be sure that we can better tailor the presentation to your needs and to ensure that you get your questions asked. One of the things to think about as we start this process is reconnecting with what you're passionate about within your business. And I always like to ask people to remember, when you first started your business, what was it that you were passionate about? What got you up? What gets you up every single day? Reconnecting with your passion is always a good idea to help keep you actively engaged in your business. And what we often see is when we start businesses, we tend to be passionate about the product or service that we're providing, but we might not necessarily be passionate about financial record keeping, right? Payroll services, all those ancillary things that go with being a business owner. So as we trudge through the day-to-day and some of the aspects of small business ownership that we might not be that confident in, comfortable with, or excited about, always reconnecting with that original passion can get you through some of those more challenging tasks of operating your business. So if you're participating virtually, feel free to drop in the chat box anything that reminds you of what was passionate about starting your business and what keeps you engaged with your business on a day-to-day basis. So let's talk a little bit about why businesses need funds. Usually the best way to determine why you need funds is to determine what is the outcome that you're seeking. And typically there are 4 common outcomes that businesses seek to borrow or need additional funding to achieve. The first is oftentimes businesses are looking to grow business and drive new sales. For example, you might be interested in opening a new location, launching a new product, or increasing your digital marketing, accessing new markets. So some of these actions require funding or new funding, additional funding to help make them become a reality. The second reason that you might need funding is to increase your production or service capabilities. If you're expanding, you might need to add new equipment or upgrade existing technology. You may need to hire and train additional staff. And sometimes you just may need to replace worn out vehicles or equipment. If you're growing your business or trying to reduce cost, you might be automating more and investing in automation to increase your production capacity. A third reason that businesses often seek funding is to help them boost their profits. So for example, you may decide that you're shifting sales from an in-person model, such as a retail store, to add or become more e-commerce in nature to boost profits. You may decide that you want to take advantage of volume purchase discounts to lower your overall inventory cost. And you may want to increase your staff productivity, either through training or other efficiencies. And finally, you may need funds to manage the cash or the capital that's engaged in your business. Oftentimes, that might be to fund your operating cycle. It could be used to consolidate debt, to build inventory for busy seasons, to handle your seasonal cash requirements, and to secure funds for those one-time unplanned expenses. So what are some of the reasons that your business may need additional funding? So as you work through your workbook, take a moment to kind of think about what is the business outcome that you're trying to achieve, And what are those action steps that you plan to take to achieve those business outcomes? And think about your existing cash on hand. Can you fund these actions with your existing cash? So where do you find funding? Right? Funding is one of those challenging things. It's always when you need money, it's hard to borrow money because you need money to pay back the loan. It always seems like it's a chicken or egg. How do I grow if I don't have enough cash? How do I get cash if I'm struggling to pay my existing bills? Right? So trying to understand where the various sources of funds are available within your business and available to you is an important thing to understand. And understanding the pros and the cons of each can help you decide what type of source of funds to help you achieve your business outcomes may be best for you at any given time. So let's talk about cash reserves. Cash reserves are those funds that you set aside in your business. Sometimes they're referred to as retained earnings. But that is the cash that you have on hand. That's what you have to invest back into your own business. The pros of using your business cash reserves is that it's inexpensive and it's a low risk source of funds. They're your funds, they belong to your business. And they're flexible to use and you retain control of the business. So flexibility, ownership control, inexpensive, and low risk are the pros of using existing business cash reserves to fund your funding needs. But many small businesses, especially young startup small businesses, typically do not have large sources of cash reserve or rainy day funds set aside. So accumulating reserves can take a very long time for small businesses. And if you use too much of your cash reserves, then that limits your ability to tap into those when you have an emergency or another cash need that might arise in your business. The second type of source of fund to consider is an equity investment by the owner. That's your money as the small business owner. It is what you put in to the business. And generally, owner investment equity is the primary source for startup and early stage businesses. And because you are the one putting the cash into the business, you have quick access to those funds. It's really important that owner equity is a portion of your capital stack because other equity investors or lenders always want to see that the small business owner has skin in the game, right? If your business is not important enough to you to invest your own money, then it's highly unlikely that other people will have the same confidence level to invest their money in your business. So the con of using owner equity investments to fund their cash needs includes, it requires additional cash from the owner from your own personal funds. And that may oftentimes create personal financial stress. Because if we're taking our own personal funds to cover our business expenses, then it's reducing what we have for our own personal household expenses and lifestyle. There's also equity investment from external funding sources. These are generally going to take an ownership interest in the business, which may be a con. And this typically requires repayment. And because it's provided as equity up front, it's generally repaid if the business has future profits sufficient enough to return profits to the investor. And that investor is going to want to expect a higher rate of return for taking this slower repayment off of potential future profits. So it's a much higher risk for them to invest in your business. That's typically why they may take up some ownership control of the business and become a partner in your business. Generally, the pros is that these are no set repayment schedule. It's generally based off of future profits. And the potential industry expertise and connections from your outside investors may help boost your sales or bring additional expertise to your business, or other capital investors that you may have not have known about or had that expertise. And then finally, there's borrowing. And borrowing is often the lowest cost form of outside financing. You do not give up owner control of your business or ownership control, any equity that's put into your business and profits. Loans get repaid by the cash that's earned on your business. So you need to demonstrate that you earn sufficient income to repay a loan that you have borrowed. And that loan is repaid with interest over a set schedule and may require collateral.
Marla, not to interrupt you, but let me ask you a question on the equity investment from external sources as you're talking about the borrowing. What if someone is not familiar as to where they find these type of investors? Is there a way you can is there a place you can recommend them, or agencies you can recommend them to go to find these type of investors?
Yeah, there's quite a few different type that are out there. There are some that are like peer-to-peer learning exchange or lending exchanges. And usually you can kind of Google and search, right? Venture capitalists are typically interested in fast growth, innovative businesses that have some innovation component to it. Angel investors are typically investors that are from the local community that are interested in supporting startup businesses. So for example, in West Virginia, there's the West Virginia Angel Investors Network. So, Google search and see what might be available in the Kentucky market. Also, CDFIs, or Community Development Financial Institutions, are community-based lending institutions that often have a really good pulse on the venture capital that may be available to small businesses within the communities that they serve. In the Lexington market, Community Ventures Corporation is one of the community development financial institutions that covers the market there with both microloans and larger loans to assist startup businesses and expanding businesses. And they would be a really good resource to tap into to see if they have any recommendations on good sources of venture capital.
Okay, thank you.
You're welcome. So one thing to always consider is that skin in the game, right? How much do you have in cash reserves that you can put towards the project, and how much versus borrowing, right? So one of the things that you need to do is assess your cash reserves, right? How much do you have in cash reserves? And keep in mind, how long did it take you to build that cash reserve? Do you have any other plans to use your cash reserves? Do your current profits support reinvestment back into the business? In other words, do you have sufficient cash flow and sufficient earnings from your business that you can reinvest back into your business with those retained earnings? Does your current cash flow meet your needs? Are you able to fund your current inventory needs, your current payroll needs, to fund your current operating cycle? Have you made any plans to secure more equity? And if so, who's going to provide it? Will it be an owner? Will it be your equity or cash putting into the business? Would it be an outside investor, a silent partner, etc.? Also, assessing how much debt that you currently have. And do you have plans to borrow more? So understanding your current cash position, your cash flow position, and your debt position helps lay the foundation for understanding what your resources are to repay a loan or an investor and determine how much owner equity is needed to fund your future growth plans and business outcomes. So a few things to keep in mind. There are different types of financing, and each of them can be used for various purposes. So let's talk a little bit first about a business credit card. Business credit cards are typically the easiest type of credit for a business to get. And it is always a good idea as a small business to have a small business credit card versus using your own personal credit card for business expenses. It's extremely important to separate your personal and your business finances. So having a credit card that is in your small business name helps keep your record keeping clean and separate. And it also provides an itemized statement at the end of the year that can help your accountant or bookkeeper identify various taxes or tax benefits and tax breaks that you may be eligible for. So it's a good way to keep a handle on your daily spending, receipts, and it can also be good for those everyday purchases. You can earn rewards based on your spending and earn those cash rewards to spend on other items. And they're also good for what we call very short-term borrowing needs. And when we say very short-term, that's generally a borrowing need 6 months or under. Typically, a small business credit card is unsecured without collateral, and the interest rate charged is typically a little bit higher than a traditional business loan. And it is what they call a revolving line of credit. So you can draw down on, you can, charge up towards your limit. And as you repay, that amount available to borrow again reopens. So it's an unsecured revolving source of borrowing that builds credit in your business name, provides a detailed accounting record of your purchases for everyday purchases, allows rewards to be earned, and can meet your very short-term borrowing needs. You also have the ability to transfer balances from higher interest rate credit cards, business credit cards, to perhaps lower interest rates credit cards, which can help you save money over the long run. Generally, payments work by there is a minimum monthly payment amount, and that interest accrues on a regular basis. And you have the ability, if you pay the entire balance, to avoid some or all of the interest charges. It's always a good idea to pay more than the minimum monthly amount, and if possible, to pay the balances in full. Typically, the interest rates are variable, which means as interest rates in general rise, and we are in a rising interest rate environment, you may see that the interest rate on your credit cards will fluctuate. They're typically tied to some prime rate and will fluctuate as that benchmark rate increases or decreases over time. So if this is something that you may need, be sure to kind of mark a need and explore if a business credit card is right for you. You can walk into any bank, and I'm sure that they would be glad to assist you with seeing if a business credit card is a good fit and an option for your business. The second major type of borrowing is a business loan. And business loans can be used for a variety of different purposes. They typically fund either major purchases such as equipment, or it can fund one-time cash needs, such as inventory, or any special cost that may have an emergency that may have popped up that you were unexpected and had a one-time expense. Typically, when a business loan is originated, it can either be secured or unsecured. If it's a secured loan, the collateral is typically what you're financing. So if you're financing a vehicle, the collateral is the vehicle. If you're financing inventory, then the inventory will typically be the collateral. If you're financing equipment, then the equipment is typically the collateral for a secured loan. Generally, these loans are amortized, which means they're going to set the term of the loan based on the functional need. So if you're purchasing inventory, the repayment may be set for a year, right? You buy inventory, you're expected to sell it and repay the loan with the proceeds of the inventory sold. If you're financing equipment, it will typically be financed for the length the length of the depreciable value of the equipment. So if the equipment has a useful life of 5 years, then the loan will probably be structured as a five-year loan. And if you're funding operating lines of credit, generally those are 1-year loans that need to be repaid, or what they call, pay down to zero at least one time per year. These loans, typically the balance is reduced over time based on the loan maturity. And typically these will be fixed rate loans that are locked in when you close your loan. However, some can be variable rates. That's up to you and your lender to decide what's the best option for you. And generally, the larger the loan size, the more need for collateral there may be. So if you are thinking about purchasing equipment, inventory, vehicles, or any other type of business loan, mark the box that this is something that you may need, or if it's existing loans that you have, you may want to mark the box have, identify what your loan balance is and what your payoff date is. Note your interest rate and what your current monthly payments are. It may be worth exploring refinancing that existing debt to see if you can get a better rate, better terms, and reduce your loan payments. So refinancing business loans is certainly something that can be done when the time is right.
Marlo,
Yes.
did have a quick question in the chat here. How do you all decide how much a business can borrow, as well as does the business have to be 4 to 5 years old to be considered for borrowing?
Excellent question, and that's a hard one to answer because it really depends on the business loan and what your profitability of your business is. Generally, small businesses that are startups are a little bit more difficult to finance because they're typically not showing much profit. So if a small business loan is being underwritten, they're generally going to look at the small business owner who will be the guarantor on the loan. They will be looking at their cash availability to repay the loan. So if the small business is currently not showing profitability or ability to repay a loan, there is the opportunity for the small business owner to be a guarantor on that loan and to basically guarantee the loan with their own personal ability to repay. In that case, they have to have the personal funds and personal cash flow to be able to repay that loan. So it varies based on the personal financial situation of the business owner, as well as the current cash flow and profitability of the small business as to whether or not a loan, the ability to repay a loan is there. The second thing that they'll look
another
at.
question, Marla, while you're talking about that. How does the small business decide on a business loan versus a business line of credit?
Right. Business lines of credit are typically going to fund short-term needs and your operating cycle. So let's talk a little bit about what an operating cycle is. An operating cycle is a big circle, like a donut. And it starts, they like to call it the cash to cash cycle. So for every $1 of cash that enters your business, what happens to that cash as it revolves through your operating cycle? So let's use two different examples. We have a restaurant with a catering business, and they go cater an event. The first thing they have to do is use their business cash to go buy food or inventory for that project, for that catering event. So they need cash to purchase that inventory, those food products. So do they have cash on hand in their business to fund their inventory needs? If not, they're probably going to do an inventory line of credit or finance those short-term, short needs on a business credit card, right? So that's how they're going to fund their inventory for their catering business. Now that inventory's got a short shelf life, right? Food doesn't last long. So it's not like they're buying it and it's going to sit on the shelf for 5 years, right? It's got some food waste. So it's a short inventory cycle, right? That inventory sits on the shelf for maybe 5 days. So you need to carry that inventory for the days on hand, the days that it sits on your shelf before it's used. So in this case, it may be 5 days that you need to fund your inventory. So you show up at your catering event, you do your event, and then you bill your client to pay you. And you give them 30 days to pay you. That's your receivable, right? So during this time, you've got your inventory that you've purchased and used, but you've not yet collected money for. And in the meantime, you still have bills to pay. You have to pay the people who work the catering event, right? You have to pay the gas for your van that took the food there. You've got to pay the van payment, the car insurance payment, etc. So you still have bills to pay while you're waiting on that receivable to be paid. And since you gave them 30-day terms and we hope that they pay you on time, you have to fund 30 days worth of inventory receivables. So now you've got $1 in your inventory, You've bought your product, you've billed, and you're waiting 30 days to get that dollar back when it gets paid. And in the meantime, you're funding out all your payables, right? So how do you pay your payables? Do you pay them weekly? Do you pay them twice a month, monthly? So suppose you decide I'm going to pay all my payables twice a month. So every 15 days, I'm going to make those payables, right? Now we've got 5 days of inventory on hand, 30 days of receivables on hand. That's 35 days that you need to have funded in your operating cycle. But your payables are actually you borrowing money from someone, right? They've given you something and now you are paying them. So if you've only got 15 days, then you can take that off your 35 days because you're borrowing 15 days. So that's reduced your cash needs to 20 days. What is your business line of credit for? It's to fund that 20 days of cash that you need to run your business until you collect all of your receivables. That amount that you just identified based on the days of cash on hand you need for your inventory, your receivables, and your payables is called your cash to cash cycle. That determines your permanent working capital need. That is what is the amount of your need for an operating line of credit. So generally, that operating line of credit can either be funded through your cash reserves. And if you don't have sufficient cash reserves, that's when you go into a borrowing need for an operating line of credit. And generally, that's how much need, right? So when your lender's looking to determine how much funding is needed for an operating line of credit, they're looking at your cash to cash cycle to determine what that need is. Does that make sense? I know that was a long-winded answer.
No, it makes sense to me, but let me ask you this question as a follow-up. Is it easier to get a line of credit versus a business loan, or is the same criteria in obtaining both?
Operating lines of credit tend to be the more difficult piece of funding.
Okay.
For startup businesses. Now, if you're an existing business with sufficient cash flow, business lines of credit are pretty much a staple in the way that businesses operate. But as a startup, that is the most difficult piece of funding to find. And generally, that is where they say owner equity comes in, and using cash reserves, using your own, the cash from your business should always go for that operating cycle first.
Okay.
To fund your business needs. This is, if you don't fund your cash to cash cycle, you go out of business.
Okay.
Business loans are typically things that you're purchasing something, inventory, and how much are they going to lend on inventory? It depends, right, on the business type. If you're a farm and you're funding cattle as your inventory, right, they're probably going to fund 70% and require 30% equity. Why? A bank doesn't want to take care of cattle if we have to repossess it, right? Generally, inventory is going to be anywhere from 60 to 80%, depending on the type of inventory being financed. Generally, equipment is 60 to 80%. Business loan, depending on how specialized the equipment is. If it's kind of general equipment that every business uses, then 80% may be typical. If it's highly specialized equipment that only your industry uses, and there aren't very many people that would be interested in purchasing used equipment, that piece of used equipment, should the bank have to take back the collateral and sell it, they look at the useful life as well as how specialized that equipment would be. So the percent that a bank will lend on inventory or the percent that they'll lend on equipment will vary depending on the nature of the inventory and the nature of the request being made. And these can be secured or unsecured, again, with most of them being secured. And we kind of discussed over here our lines of credit. And generally, lines of credit are 1 year and they renew annually. And they require a zero pay down at least once per year. There's a couple other loans that might be of interest. A construction loan, and that's typically a real estate loan. If you decide that you're going to do construction of a new building or rehab of an existing facility to make the business, more functionable for you. So there's a construction loan, and then it's converted to a commercial mortgage once the construction loan is paid off. And then there's also business leases. Leases may be equipment leases, vehicle leases, or real estate leases. Instead of a loan. There are pros and cons to leases, and really discussing with your accountant which is the better option for your business, because they show up on your balance sheet a little bit differently, is probably a good idea if your business is cash strapped. And then there's always the SBA guaranteed loan program. And as I mentioned, community development financial institutions, particularly for startup businesses and low cash flow businesses, typically have more flexible lending terms. So where can you go get funding sources, right? Other than lending or with including lending? Let's talk about them. We've got our friends and family, right? These are great sources of investment, loans or equity, particularly at the startup or an expansion phase. However, the con to having friends and family is their friends and family, right? They might want to be in your business a little bit much more than you care for them to be in your business. If you don't repay them, there may be some hurt feelings and damaged relationships. So be aware that while friends and family are often good sources of support in the early and expansion phases, there is the relationship aspect of borrowing or accepting money from friends and families that can complicate relationships over the long term. Again, there are equity investors, such as angel investors, venture capitalists, and other private equity companies. They generally want a return, they want an ownership stake in the company as long as they're an investor. And generally, they bring some level of industry expertise and other connections to your business. CDFIs, as I have mentioned, they're community development financial institutions, and they exist to assist startup small businesses and to help businesses grow and thrive. Crowdfunding through various crowdfunding platforms is always an option. And many small businesses get their start raising funds through crowdfunding. This is very popular with the younger crowd and has been very successful in a lot of cases. There's peer-to-peer lending sites. A couple include the Funding Circle as well as Circle Up are two. They tend to serve harder to lend to businesses. And there's really not a lot of support and advice and guidance. It's all about peer-to-peer lending and providing additional resources. And then online lenders that are out there, beware. There's a lot of them out there, and generally they charge much higher interest rates. And some are good, some are not so good. So you really want to do your research on online lenders. And there are some what they call accounts receivable funders, such as credit card companies, that will loan you money, but they basically reach into your bank account on a daily basis and take a percent of whatever cash you receive or whatever sales you receive during that day. So they can be a little bit tricky. They can be a little bit higher rate, and you have to watch the way that they want repaid, because oftentimes it's a daily cash sweep out of your account. So those are just a few things to be aware of. Again, friends and family may be easier to obtain. They may offer lower interest rates and flexible repayment terms, and it can add a lot of strain and stress to family and friends relationships. Equity investors, they can provide funds in exchange for ownership share. Typically no payments. They're seeking a share of the profits and proceeds from an ownership sale at the future. Some investors are experienced business owners and may provide practical advice and want input into the business decision. And finding the right investor can be a long, involved process. And they typically are looking for fast growth and innovation. And again, as I mentioned, community development financial institutions. And again, Community Ventures is a popular one in the Lexington market. Online lenders, again, fast decisions, quick funding, sometimes within days. There's predictable monthly payments. They're more lenient on credit criteria, oftentimes less documentation, typically higher interest rates, and typically it's difficult to find for large dollar amounts. They typically do small dollar amounts. Peer-to-peer lending sites, again, Funding Circle and Circle Up are two, and crowdfunding, Kickstarter and Fundable are two of the more popular ones for small businesses. So let's talk a little bit about what lenders look for as they review a loan application. It's what we call the 5 C's of credit. And those 5 C's are credit history, capacity, capital, conditions, and collateral. So let's take a look at each of these. Credit history is often referred to as your character. And I've always joked around and said your credit report is the numeric value of your character. It states that you pay what you said you're going to pay, and you pay it on time. In other words, you do what you say you're going to do, and you do it responsibly. Generally, they're going to pull both your personal credit history as well as your business credit history. And why it's important is that it proves that you pay your obligations on time and in full. Lenders basically assume that if you've paid other people well, that you will pay them well. They will assume if you didn't pay other people well, that we probably won't be paid well either. So it's always a good idea to check your personal credit report and your business credit history prior to a loan application, so you can get an idea if you're in good shape or if you need to do some work on both your personal and your business credit. Things that you can do: make sure that you're paying your bills on time and your debt payments on time and in full, and to maintain an excellent credit rating. The second thing that they're going to look at is capacity. And capacity is basically your ability to repay a loan. And they're going to look at both your, they're going to look at your business first, and then they're going to look at your personal. So does your business have enough sales and profits to pay all of your expenses and repay this new debt that you're about to take on? They're going to look at your tax returns and your financial statements. So remember this, your accountant is typically preparing your tax returns and your financial statements for one purpose: to help you get the most tax benefits that you can receive as a business owner. They will typically try to show your business at a loss, right? So that you can, or with less profit, so you pay less taxes at the end of the year. That might not be the best strategy if you know you need to borrow, because your capacity, your ability to show a profit, an ability to show that your business has sufficient funds to repay the loan that you're getting ready to take on is critical. So if you think that you're going to be borrowing within a year, you may want to start talking with your accountant about looking at your financial statements and how to best structure your finances and your financial statements, not so much to benefit your tax returns, but to benefit your capacity to be able to repay that loan and to demonstrate to a lender to repay that loan. So working close with your accountant and letting them know what your business strategies are in the upcoming year will help them best. It will help them help you achieve those goals. We're also going to look at your checking account history, see, that what's coming in, what's coming out, and make sure that there's no overdrafts. We're going to understand whether or not that you're running a profitable business and that you understand your finances. The next thing we're going to look at is capital. And capital is equity, right? It's your owner's money. What is it that you are putting down? Your down payment for whatever borrowing needs you have. And they're going to look at it through a few different sources, right? They're going to say, do you personally have excess funds that you're going to put in there? Your personal liquidity. Do you have equity in other stuff that you could put up as additional collateral, right? Do you have equity in your house? Do you have equity in a farm that you may own? Do you have equity in a building? Do you have equity in stocks, bonds, other things that you may be able to put up as equity? What is your business and your personal net worth? And is your business liquid? We're going to look at your checking and savings accounts. And again, your financial statements. Do you have enough profitability and retained earnings to put cash into your business? If one thing goes wrong, do you have enough cash to be able to continue to repay us? Generally, the rule of thumb is expect to have at least 20% of a down payment or owner equity or equity of some type going into the loan, with the bank financing 80%. And as we discussed earlier, that ratio of 20 to 80% is going to vary greatly depending on the loan request and what it is that you're financing. Specialized equipment versus general equipment might require more owner equity. The other thing we're going to look at is conditions. And conditions are those economic factors that are going on in the world. So for example, if you're an incandescent light bulb manufacturer and the world is moving to LED, those are some conditions that may impact your business, right? During COVID, as hotels were shut down and restaurants were shut down, it was really, really difficult for them to obtain traditional loans because of those economic conditions, right? It's hard for them to repay when they're not open. So having a clear understanding of the economic pressures that your business and industry might be facing, or that the general economy is facing, is really important to understand. And what is your backup plan, right? In case one of these economic downturns impacts your business, what's your plan B? Right? Because we're going to want to know, in the event the worst thing in the world happens, another pandemic, what's your backup plan to survive? So having that plan B and understanding the risk, the economic risk and industry risk, is really important. And what we will do is pull the economic outlook from Dun & Bradstreet, and get the industry economic outlook for your business type. We're going to look at your business financial condition. Can you weather a downturn in the economy? And then we're going to look at the loan purpose. And then finally, collateral. And that's collateral is basically you're putting up existing assets or assets that are being financed, that the bank can take and resell in the event you default on the loan. Collateral is generally referred to as the second way out of a loan. Most banks don't lend just based on collateral. These top 4 factors are your ability to repay. That's the number one thing a bank will underwrite on, is your capacity to repay. Then they're going to look at your past history of repayment, right? And then they're going to look at the economic conditions that may impact your ability to repay. And if all else, that's how they'll determine the loan. And the collateral is the second way out. The collateral is really, in the event that you default on your loan, we take that collateral and sell it to repay the shortfall in the loan that's the loan amount that's still due. So collateral is generally considered that second way out of a loan. So don't expect, just because you're putting up collateral, that is the primary factor in underwriting a loan. It's generally the secondary factor.
No, Marlo, that's great information. Not to I see you have one other slide. If you wanted to show that other slide, because we normally have a hard stop here in about 3 minutes, but if you wanted to go through this one.
Absolutely. So the borrowing process is basically you've identified that you needed a loan. You put in an application for an official request for credit. That application goes through an underwriting process. Then it's decisioned. It's either approved or declined. If it's approved, it goes through the processing phase, which may require appraisals and other final requirements, credit reports, et cetera. Then it goes to closing, which is where the loan documents are signed and the loan is funded. And then you begin your repayment sources. And in your student workbook, on the last 2 pages is a borrower's profile. I highly recommend that anyone looking to borrow spend some time completing these 2 pages. This will give you the foundational information you need to structure a conversation with your lender that lets your lender know that you have thought out your lending needs, you've identified your ability to repay, and that you have pulled together all the information that's needed for the application checklist. So this is a very useful tool to have in your toolbox to prepare for a loan request.
Yeah, and I suggest that all of you all go to the either the start of this presentation where they have the QR code that allows you to get to this handbook, or you can go to the Urban League social media pages, and these handbooks are available for download at those locations. There's the QR code. Well, Marlo, I'd like to thank you for being a part of the Urban League's Workforce Wednesday and giving us information, especially for the small businesses, as to what they need or how they can get in step to borrow to grow their small business.
Well, thank you for having us. Look forward to doing another one.
No problem. I enjoyed it. And with that, I'd like to thank our sponsors, Truist Bank and Toyota 2 Show, for bringing us these programs. And again, visit the Urban League social media pages to obtain all this information and to see what we have going on here at the League. Thanks a lot, and see you at the next Workforce Wednesday. Bye-bye.
Bye.